Welcome to Talk Tickers. Today, we're diving deep into what I can only call a corporate survival saga. It's playing out right now in the twilight zone of the SPAC market.
It really is.
Our focus is AlphaTime Acquisition Corp, ticker is ATMC. And if you've been tracking that whole cohort of SPACs from the 2021 boom, this story is, well, it's a perfect microcosm of what happens when the clock runs out.
And the cash runs dry.
Exactly. And desperation starts to set in.
That's right. Our mission today is to really unpack this critical maneuver ATMC just pulled off. They managed to extend their business combination deadline.
Barely.
Just barely. And we need to analyze the intense financial distress and the regulatory pressure that really forced their hand here. We're going to show you why this isn't just some boring regulatory filing.
Right.
This is a high stakes bet where the company they're trying to buy is, and this is wild, literally funding the acquisition.
Okay, so let's start with the snapshot. Give us the core event.
All right, so the key date is December 16th, 2025. That's when ATMC shareholders, whoever's left of them, approved an amendment to extend the deadline to complete their merger.
So they were up against a wall. The old deadline was January 4, 2026.
It was looming. They now have up to 3 additional 1-month increments. So that could stretch the final closing date all the way to April 4th, 2026.
So they bought themselves 90 days.
They bought time, yes, but look at the cost. After that meeting and the redemptions, the trust account was left with only about $4.8 million.
$4.8 million. And what's really wild to me is the number of shares that were redeemed in that final vote.
Almost non-existent. Tells the whole story. Only 69 shares were redeemed.
69. Just 69 shares. What does that signal to you?
It tells you the public investor base has basically vanished. Anyone who was skeptical or, just wanted their cash back, they got out a long time ago in these huge earlier redemption cycles.
So who's left?
The people who are left are like a highly consolidated group. You're talking about a handful of institutional holders, maybe some arbitrageurs who are willing to bet on the merger actually closing at this point.
And what is the merger they're fighting so hard for? Who is the target company?
The planned merger is with a company called HCYC Holding Company. They're an intermediary insurance brokerage. They operate out of Hong Kong.
An insurance brokerage?
Yes, their subsidiaries are licensed for professional insurance brokerage in the region.
Yeah.
And this deal with HCYC is, it's the only reason ATMC still exists.
Okay, so let's zoom out a bit. ATMC's situation, this desperation, it isn't unique, right? It sort of reflects the systemic pressure on all SPACs from that era.
Oh, absolutely. if you look at the context, ATMC's IPO was back in January 2023. They are part of that massive wave of SPACs that launched in the 2020, 2021 frenzy.
And now the clock is ticking for all of them.
The clock is ticking. They're all facing these hard deadlines. And when that happens, especially when the SPAC hasn't found a great target or adequate funding, it just creates this immense pressure cooker. The sponsors are under pressure to secure any deal to avoid liquidation.
Because liquidation wipes out their founder capital.
It wipes them out completely.
Yeah.
And that pressure can really compromise the valuation, the terms, everything.
And that kind of compromise is exactly what draws the attention of regulators, doesn't it?
It's a magnet for it. You get increased scrutiny from the SEC, and maybe even more dangerously, you get attention from litigators. They're all watching for signs of what they'd call a rush deal.
Right.
The standard legal advice every sponsor gets is, do not rush the transaction at the expense of quality. Mm-hmm. But, when you're faced with liquidation or closing a messy deal, that advice gets tested.
And the history of ATMC's capital drain, it just perfectly illustrates why they're so desperate. Let's walk through those numbers.
It's a really stunning display of shareholder skepticism.
Yeah.
The first major redemption was in late 2023. That took out $23.3 million.
Okay, so a big chunk right there.
A huge chunk. But then came the really painful one, December 2024. A subsequent redemption removed approximately $38.85 million.
Wow.
And you have to look at the price. That redemption was done at $11.41 per share.
So well above the $10 IPO price.
Exactly. Investors were taking their initial capital plus all the interest it had earned in the trust and just walking away.
Which left the total number of shares way down, just over 3 million, right?
Yeah.
3.47 million.
Correct. And those cumulative redemptions are exactly why they're down to that $4.8 million figure today. The public float is just incredibly small now.
And this wasn't exactly a smooth ride from a leadership perspective either.
Not at all. That's another fascinating layer. You had this mid-process executive shift. The former CEO, Daijang Guo, he resigned in March 2025. The reason given was, quote, personal reasons.
Which is always a huge red flag during a critical period like a merger.
A massive red flag. He was succeeded by Gan Kim Hai, who used to manage the Rise Sun Group's office in Malaysia. So you have a leadership change while the company is navigating its most challenging period ever. It just adds another layer of profound uncertainty.
Okay, so they've bought themselves this 90-day reprieve. Let's talk about the hurdles that are still in front of them, starting with the diligence on HCYC's financials.
Right. So any investor still in this, or anyone thinking about stepping in now, really needs to sharpen their pencils on HCYC's financial projections.
Because SPAC deals have to disclose projections, unlike a traditional IPO.
That's the key difference. The S-4 filing requires them. And we've seen this clear trend where if the merged company's stock tanks after the deal, those projections become Exhibit A for litigators.
They become the basis for a lawsuit alleging misrepresentation.
Exactly. So the pressure on ATMC's side to get a deal done must be influencing how those numbers are presented. Everyone knows they're desperate.
Which leads us straight into governance and conflicts of interest. The courts and regulators are all over this right now.
They're hyper-focused on it. The core issue is making sure the sponsors' interests, the insiders with the founder shares that become worthless in the liquidation, are aligned with the public shareholders who actually put up the cash.
So how does a SPAC like ATMC in this position, how do they even try to mitigate that perception, the perception that they're just doing a deal to save their own skins?
Well, the standard playbook involves a couple of key things. First, you appoint a special committee of independent directors. Their job is to vet the deal terms completely independently.
Pretend they don't know the sponsor.
Right. Or, alternatively, you hire a third party to give a fairness opinion, which is an independent confirmation that the deal is, fair to public shareholders. But given the extreme timeline here, any shortcuts on those steps would be incredibly risky.
And behind all of this is the fight for cash. Their biggest existential threat right now is just the immediate liquidity crunch.
Forget the future. They are essentially insolvent today without outside help. As of March 31st, 2025, they had a working capital deficit of $3.5 million.
A working capital deficit. What does that actually mean for a company trying to close a merger?
It means they literally don't have enough cash on hand to pay the lawyers and the accountants to get the deal done, let alone just keeping the lights on day to day. They're running on fumes.
And the only thing keeping those lights on is financing from related parties.
Yes, and this is the most critical and, frankly, the most unusual detail in this whole saga.
Okay.
There are two sources. First, there are loans from the sponsor, which is normal. That was about $1.26 million as of March. But second, and this is the crazy part, they're getting loans directly from the target company, HCYC.
Wait, the company they're trying to buy is lending them money?
Exactly. As of March 2025, they owed HCYC about $140,000, and then they borrowed another $285,000 just for working capital. The total borrowed from the target is approaching $500,000.
So the company ATMC is trying to acquire is basically bankrolling the acquisition. What does that signal to you?
It just screams desperation. It tells you the sponsor is either unwilling or, more likely, unable to inject the capital themselves. And this just profoundly complicates the relationship.
Because HCYC now has all the leverage.
All of it. They're essentially investing capital to make sure their own merger closes. It raises huge questions about whether they could just renegotiate the terms in their favor, knowing how dependent ATMC is on them. It's highly, highly unusual.
And while all this is happening, while they're scraping cash together from the company they want to buy, they're also fighting to stay listed on the exchange.
Yes, the NASDAQ threat. This is an immediate binary threat of delisting. Back in April 2025, ATMC got a non-compliance notice from NASDAQ.
For what?
It was related to the minimum value of listed securities, or MVLS requirement. NASDAQ requires companies to maintain a value of $50 million.
And with their share count and trust value so low, they are nowhere near that.
Not even close. I mean, the trust value is under $5 million.
Yeah.
So they are way, way off that threshold.
If they fail to complete the merger and get back into compliance, they get delisted, which would kill the deal.
It kills everything. The initial deadline to fix this was October 14, 2025. So while this new extension to April 2026 gives them time to close the deal, it doesn't automatically solve the compliance problem.
I see.
They are banking everything on completing the merger, listing the new combined company, and just praying that the new market cap is immediately over that $50 million requirement. It is an incredibly tight rope to walk.
So we've got a company navigating a minefield of low liquidity, intense regulatory scrutiny, massive capital flight, and a razor-thin share float. I mean, this whole scenario feels engineered for volatility.
It absolutely is. And this brings us to the part of the show where we put on our most speculative hats.
All right, let's do it. And a reminder to everyone, this is purely a discussion based on the corporate structure and these really unique liquidity dynamics.
This is not financial advice. We're just analyzing the technical possibilities that are inherent in this very specific situation.
Okay, so the technical structure is unique. We have a tiny public float, about 2.17 million shares. And we have a fixed known deadline in April 2026, plus a known liquidation value.
That liquidation floor is the key to the whole thing. Since the IPO cash has been sitting in interest-bearing treasuries, the floor is now up around $12.38 per share.
A very high floor for the stock price.
Very high. And the extension fee is known too. It's minimal. So given that high floor, the tiny float, and this guaranteed binary event coming up, what's the outrageous but plausible trade idea?
Lay it on us.
Okay, so we're pitching a de-SPAC squeeze long position. This would involve going long the remaining ATMC ordinary shares, ticker ATMC, and combining that with a long position on the warrants, ATMCW.
Okay, why both? Why combine the shares and the warrants?
So the shares give you a hedge. You have that $12.38 floor, which protects your downside if it all goes to zero and liquidates. But the real upside, the potential squeeze, is amplified by that tiny float.
How so?
If HCYC actually pulls this off, if the deal closes in the new shares list, any positive market reaction, or even just some targeted institutional buying, it would cause an outsized price move. It takes very little demand to move a stock with a float this small.
So you're betting that the market structure itself could magnify any good news. But if the market hated this deal so much that almost everyone redeemed, isn't this just gambling on noise?
It is a gamble, but it's a structural one. And that's where the warrants come in. The warrants provide the pure, cheap leverage on the success of the de-SPAC event itself. You know, the closing date is, at the latest, April 2026. So you're making a clean binary bet on the transaction closing. If it closes, the warrants could become very valuable. If it fails, you lose what you paid for the warrants, but the shares have that liquidation floor to cushion the blow. It's an aggressive play predicated entirely on the minimal float and the sponsor's maximum desperation to close.
A really fascinating situation where market structure and corporate desperation create this highly technical trading dynamic. So to recap the takeaway, AlphaTime ATMC has secured the time it needs to complete the HCYC combination, pushing that deadline to April 2026.
But their survival, their actual corporate survival, hinges on managing this extremely tight liquidity situation. That includes their, frankly, precarious reliance on borrowing directly from HCYC.
And at the same time, they have to navigate that immediate regulatory hurdle with NASDAQ. They can only achieve that if the merger closes successfully and the market actually likes it.
Right. The AlphaTime case is really a classic example of the intense pressure, the complex governance issues, and the severe capital depletion that's facing this whole generation of SPACs right now. It's just a stark reminder to always scrutinize who exactly is keeping the lights on when the original investors have already fled.
We appreciate you diving deep with us.